Okay, thank you very much indeed. For our penultimate session, we are exploring positioning niche private credit strategies in a portfolio. To oversee proceedings as the moderator is Mr. Jeremy Griffiths, partner at Campbell Lutyens.
Thank you very much. And thank you everyone for attending today. I know we're probably one of the last panels before people break for parties and drinks and everything, so we'll keep it as stimulating and as interesting as we can. And this is really a really interesting topic, and I think it's a topic that hopefully will stimulate a lot of discussion and thought process. And we welcome questions either at the end of the panel, but also in the middle of the panel as well. But I'm joined today, really pleased to be joined by three people who have a huge amount of experience and will explain their investment strategies to you in a little bit more detail. Paul de Servigny from IVO Capital Partners, Antoine Maspetiol from Eiffel Investment Group, and Matteo Squiloni from the European Investment Fund. So what we'll do is I'll introduce ourselves really quickly, because I think a part of the reason for this panel is to delve into managers and strategies that are a little bit less well known than the mainstream. So we'll spend a little bit of time explaining to each of you what we do, and then we'll delve into all of those things and pick up some themes as well. And again, welcome any participation from the audience. But just quickly on myself, Campbell Lutyens, some of you may know us. We're one of the largest private fund advisors in the market today. We advise on primary capital raising, secondaries, and we also advise GPs on capital raising at the GP level. And we do that in three areas: private equity, infrastructure, and private credit. I head our private credit business, and in private credit, we're active across the world, raising capital for fund managers across all different types of strategies. And we're constantly looking for strategies that are differentiators in people's portfolios and that can offer something additional to what they may already have. So that's my background. I'll pass it to Antoine to get us started on your background.
Thank you, Jeffrey. Antoine Maspetiol. I'm heading the private debt activity within Eiffel. Eiffel is an independent asset manager managing 5 billion of AUM. We have basically, make it very short, but 5 activities: private equity, private impact debt, infrastructure debt, and equity and listed credit.
Perfect. Paul?
Sure. So, hi everyone, Paul de Servigny. I work at IVO Capital Partners. So we're a French asset manager. We're a credit boutique firm. In credit, we include litigation finance, which is our alternative unlisted strategy. We see it as credit because we take it as a credit product, although it has, in our view, equity returns, which I think fits perfectly with today's theme.
Matteo?
And I'm Matteo Squiloni. I'm heading the Southern European unit at the European Investment Fund. As you might know, the European Investment Fund is a European institution. We are backed by a part of the EIB group, backed by also other commercial investors, institutional investors. We are LPs in private equity and private credit funds. We started to invest in hybrid debt equity mezzanine funds in 2009. We moved into senior strategies in 2014. And as of today, we have a portfolio that is more than 70 funds and more than 2 billion commitments into private credit strategies.
Excellent, thank you. So listen, I think just to step back, what is this topic about and what do we mean by niche private credit strategies? I've been raising capital in this market since 2009, which many people consider the beginning of the private credit market, because that's when the market was born out of mezzanine funds, corporate mezzanine and private equity generated activity. And then, of course, in that period of time as well, senior credit funds were raised to fill in the gap that banks had vacated. But I think when people think of private credit and mainstream private credit, they think of direct lending, senior and subordinated. They think of corporate credit, and they also think of sponsored private equity-backed transactions. And I think that's probably 80% of the capital that's been raised, 80% of the capital that's deployed today. So I think when we say niche private credit, we mean everything except that. One of the great things about the private credit market, in addition to the fact that it's growing, is that it can service LPs across a variety of risk returns. You can really customize what you want, all the way down from a 5% return all the way up to double-digit returns. And you can do that along a spectrum of risk return. through not only mainstream managers but also niche managers. And building diversification in the portfolio is really it's something that can be achieved quite nicely. And as the market matures and grows, I think we have more and more opportunity to do that. I think, but looking at a lot of investors, what I definitely see is an overexposure to middle market direct lending, overexposure to sponsored deals, overexposure to corporate credit. And the reason I say overexposure, I think people don't realize a lot of times how many other assets are out there that you can lend against. You can lend against infrastructure, you can lend against real estate, you can lend against consumer assets, you can lend against class action lawsuits. I mean, there's a huge amount of other assets that can be lent against. So this topic is really about exploring that and trying to get people open their eyes to what else is out there. It's not just about mid-market direct lending, which is an important part of our market and will continue to be. But I think we will all benefit from a deepening of that. So I'll probably start my questioning with the two managers on the panel, Antoine and Paul. Could you delve a little bit more in, Antoine, I guess first, your strategy and what makes it differentiated in your opinion, and how do your investors view that? What is the key unique parts of your strategy and how it's different from that sort of mainstream world that I just described?
It's true that there is a fierce competition, between asset managers, and equally a strong demand from you investors to be a bit more innovative. So we are trying to combine mainstream strategies where we have flagship funds. We've raised numerous vintage for the last 10 years with innovative strategy which not only address LPs' needs but also position themselves one step ahead. So I have two examples in mind and conscious of the time. The first one is unitranche with impact on SME lending, for instance, very niche, not a lot of players, but there is no impact dimension. I think that's one of your questions, so we will address that later. And equally, there is a funding gap. Okay, so that's one example.
When you say SME, what do you specifically mean? What size of company does that mean?
EBITDA below 10 million, or even close to 5 sometimes. So that's pretty small. Okay. One other example is when it comes to energy transition. So we can finance. It's not really corporate, but that's not that far. We can finance. We can provide bridge financing, so short-term financing, with a positive impact on climate, for instance. So very niche, but that's address the specific needs to our clients. So.
No, fantastic. And I think it's my view that it's as investors deepen their portfolios, they should have room for an investor may consider your strategy too. A lot of investors say it's too niche, it's too concentrated, it's focused on a sector. Well, yes, that may be true, but when you fit it into a larger portfolio, if you have exposure to 4 or 5 direct lenders, you're going to have exposure to hundreds of businesses, and that will be well diversified across sectors, geographies. So your exposure gives something a lot more focused, thematic, where you can drive specialization, and your investment strategies. I would imagine your pitch is that you could do a better job because your market so much better.
Yeah, absolutely, and of course we need to seek before to ensure that the market is depth enough, of course, and for the two cases I have quoted, the market is very deep. There's a lot of SME to finance. There's a funding gap, as I mentioned. So there's room for this type of niche market, of course.
And Paul, your strategy, your firm doesn't only do litigation finance, but from what I understand, that's primarily your responsibility. So litigation finance is definitely an interesting and differentiated strategy. So please help us understand a little bit more what you do.
Of course. So just in 2 words, litigation finance. So we fund legal, expert, and procedural costs of a proceeding. It's the equivalent of a non-recourse loan where you're only paid out of the proceeds of this litigation. We see it as credit with a very strong equity component to it because your returns are nothing like a coupon, nothing like an interest rate. You're talking about multiples of the amount you have lent or a percentage of the total amount returned. And next to it, we, to control the risk reward of this asset class, have added an insurance component to it to cover the risk and make it more like a structured bond kind of product, rather than everything can go well or you lose all your money because the litigation is lost. We like to look at it like a credit asset, and we think it's worth to look at it as a credit asset. It is very niche and it must be included within a portfolio, but with the asymmetrical returns you can get with litigation and the complete decorrelation of these litigations that we are funding, which can be class actions, which can be in geographies that we all know, such as the US or the UK, or in other geographies such as Europe, continental Europe, or Latin America. Well, you have sort of access to this really attractive aspect of the asset class.
Exactly what types of returns do you target, or what's the spectrum available in litigation finance?
So generally, the IRRs that are presented by the rest of the asset class are around from 10 to 30% IRRs. With our insurance protection that has a cost and that allows us to be comfortable with our risk reward that we are offering investors, we're more tabling around 15% IRRs net. And that's something that we see as extremely attractive in today's markets, with a correlation that is completely absent with any other event or context.
Excellent. And Matteo, moving to you, the European Investment Fund is a really important institutional investor in Europe, supporting private equity, private credit, supporting small businesses, supporting corporate development. For the EIF, what are your objectives when you look towards niche strategies, diversification? What are you trying to achieve as an investor when you support these types of strategies? And I'm sure it'll help other investors in the audience perhaps go on the same journey as you as to why you value these opportunities.
No, indeed. So by nature, the European Investment Fund is focused on a niche, that is the lower mid-market. As you mentioned, that's, the size of private credit funds in the last 3-4 years has exceeded on average the billion for each fund, so 1.3, the last figure. We are, on the contrary, focused on the lower end of the market, so with funds that goes from 100 million to $500 million. So very focused on the type of company that Antoine was mentioning before. 80% of the funds that are raising 100 billion are focused on sponsored deal. We tend to focus on the other side when we see a tremendous demand from SMEs to have alternative financing for their growth, while only 20% of the dry powder in private credit is take all those companies. And we do this by not trying to invest in, also not be shy to invest in first-time team, not be shy to invest in emerging managers, that really have maybe the right experience and the right backgrounds to tackle those small businesses in sponsorless transactions. And more recently, I would say that we have a strong move internally to find niches and thematics on this space of the market. So not only SMEs, not only lower end of the market, not only first-time team emerging managers, but we really try to select niche strategies that are tackling innovation, so also in private debt, so not only in private equity, but they're tackling innovation, tech, or impact, sustainability, environment, gender. So the more we try to bring the attention also of private debt managers that are a little bit more shy compared to private equity to tackle those strategies, the better it is for us. I mean, in general terms, I would say that internally we are starting to change. Instead of speaking of direct lending, we try to speak about impact lending and try to select impact strategies in both innovation and sustainability.
You're obviously managing public money. It's extremely important that you don't lose capital. You do a good job for the European Investment Fund, for European taxpayers. And your risk management must be extremely rigorous. I would imagine some investors, when they hear you talk about niche strategies and differentiated strategies, SMEs, innovation, they may think, oh, this is risky. We can't get this through our investment committee. It's too difficult. How do you deal with those challenges institutionally of getting less well-known strategies through investment committees, getting approval to do them. Is that a challenge for you, or are you at an institution? I know the EIF is an institution that almost has an ambition and a mission to develop growth here, but of course you have risk management protocols. So how is risk management? How does that factor into the thought process when you're backing less well-followed strategies?
We have different resources that we manage. We have public resources, we have semi-public resources coming from development banks, and we have also purely commercial money that we are managing on behalf of third-party investors. We try to give to each of those clients a well-diversified portfolio. As I mentioned, we are invested in already more than 70, 80 funds in Europe, which is a lot compared to if you take that we do not invest in the large players. And basically what we try to offer them is also diversification of the number of lines, diversification of strategies as well. We have also, as I said, we invest in hybrid debt equity, so subordinated. We invest in pure senior with what we call it a selective strategy, so more on a private equity style approach to the private credit, so building portfolios of 15, 20 lines with a high selectivity, deep due diligence, etc. And we have also this selective loan funds tends to be cash flow lending, even if in most of the cases sponsorless, but still cash flow lending. While on the other strategy, that is what we call diversified, we do not only have, so they build portfolios of 40, 50 lines more, and they also have some asset-based lending in there. They have marketplace lenders that they can have extremely high diversified portfolios. So we try to each of the investors to give the right risk return that they want. Commercial investor wants the 8-10% net. Then we have more policy to sustain first-time team and new strategies, and we try to do this by diversified as much as we can, so that
Great, that's very interesting perspective. Moving back to Antoine, I think we all know, and everyone's keenly aware as to how important impact. Investors are really trying to make an impact, positive impact in their investment strategies on the environment, on social issues. Hugely important for so many people. Obviously, there's a very different spectrum of how that's done and how it's applied and what it means to different people. But I'd be very, very keen, given that impact is hugely important to Eiffel as a firm, and that you clearly are driving that through your investment strategy. What does impact and sustainability mean to you? How is it implemented in your strategy? And then how is regulation through the SFDR and your Article 9 classification? Does that help or does it not help? Does it hinder you? How is increased regulation influencing your strategy and impact? But I think part of niche is really, you could consider ESG as a broad overlay, which I wouldn't consider to be niche. But if you consider it a very thematic, specific approach where you have an Article 9 fund, that's probably niche at this point. So I'd love to hear your views on that and how you view it.
I think we all agree that this ESG component must be part of our job every day, and I think it was probably not the case 2 or 3 years ago, not the case 5 years ago. Now it's a must. I think we all agree on that. The question is, how can we make it concrete? And also, I think there's the consensus about the fact that there is no consensus. When we talk about ESG, there's a lot of philosophy, a lot of debate about what is it exactly, what does it mean, how do you measure it, and how it translates into a concrete action when you do an investment. I think, honestly, I don't have the answer. What we do, and this is our motto, is everything we do must be concrete, so measurable. We make sure that each investment we make, it's translates into something very concrete for the investor. So I give you an example. If an investor gives us 50 million, I will make sure that at the end of the year, he will know exactly the number of jobs created, the number of the impact on climate on the climate, you know.
Carbon footprint.
Yeah, sorry, thank you. And if we are not able to measure it, we won't communicate on that. I think we have to be very humble on this thematic because we don't have the answer. So we have to progress step by step, be very transparent. You were talking about the regulation. I think it's not always very clear, but it helps at the end to give a bit of discipline in the market. Okay, so we were the first to launch what we call an impact debt fund with impact covenant, which means that we replicate what we have, in debt financing with financial covenants. So this is typically something very concrete. Ultimately, we would like to ensure that if a company doesn't comply with its objective, it can trigger default. That's pretty strong. Okay, I can give you a lot of examples, but again, it's very important to make it very, very concrete, measurable with additionality, and able to report it to the investors so that they can identify precisely the impact of their investment. Sorry, it's a bit long answer.
No, perfect. Thank you very much. And Paul, litigation finance, we talk about niche strategies. One of the main objectives is diversification. It seems to me like if we will be going through an elevated default environment. We are in a rapidly rising rate environment. We know what happens through economic cycles when that happens. It seems to me like litigation finance is truly uncorrelated to that, right? There's clearly risks in your strategy, but in terms of correlation with the rest of the corporate credit market, it seems like you can really offer that in your strategy. Is that right?
Well, today, so we've been in the market since 2014. Doesn't make us the oldest actor, but one of the oldest European actors in the market. We don't see that correlation happen in terms of we've not gone through, obviously, the biggest crises in the past, but on the contrary, I would say there's even more litigation and there's even more need for funding of quality litigation and of quality claimants, which can be companies in default, which can be liquidators, and which are actually claims that we want to look at. So it's maybe the correlation goes the other way. We're actually happy that we're in these complicated times and that our funds are gaining access to these types of claims. But I mean, I'm pretty confident that, yeah, as well as the existing portfolio of claims that we have being affected by the changes in the market is very unlikely. And then on the contrary, benefiting from these difficult times is something that we are able to gain from with the funds that we have available to deploy, obviously.
And Matteo, I know a lot of what you've been looking at are, and EIF in particular, is supporting in Europe, for example. Very few businesses in the mid-market, lower mid-market, are actually owned by private equity. Most businesses are owned by families, entrepreneurs, employee-owned businesses, right? So if you want to service the European corporate community, it's about servicing that community, not necessarily private equity firms, many of which are in the 3 floors in this conference, right? I would argue that it's an important point to make because most of what we see in private credit is servicing sponsored activities. So how are servicing or financing non-sponsored businesses, how is that different? Do you consider that niche, and should it become less niche? I mean, should it become more mainstream as private credit matures and grows and develops? And what are some of the challenges you see in the sort of non-sponsored market, family-owned market in terms of, or do you see actually an opportunity there from a risk-return perspective?
We see a lot of opportunity there, and we definitely believe it should be more of a mainstream strategies. So we see a tremendous demand from SMEs, and we actually saw, and we have evidence now in the last 7-8 years of track record that the default rate is actually very, very, very low in our portfolio.
Families tend to be much more conservative, right, in terms of their
Exactly.
their growth ambition, their leverage ambitions, right?
Yeah, there's a lot of elements why we believe this strategy is giving very good risk return profile for investors. First is competition. So there's much less competition. All the big players are focused on sponsor, and this goes at the expenses of pricing and expenses of protections. So covenant-like structures, very high capital structure where you go up to 6, 7, 8% times EBITDA, while this is not happening on sponsorless. So competition, then they're usually more flexible. They go directly to the entrepreneur. They manage to have to tailor the loan really to the needs of the companies and not to the needs of the private equity house. So they really have tailor-made covenants a lot. Usually it's difficult to see a loans in the sponsor less with less than 3-4 covenants. Capital structure in our portfolio, we are at 3.3 times EV/EBITDA at entry, so very, very conservative. And this direct contact, so they're usually the sole lender in the deal. And what we observed is that being the sole lender, having the direct contact with the entrepreneur or with the management team of the portfolio company, it's very beneficial also in the credit management. No? So your monitoring is much better than to have a private equity there that is giving the information that they want to you and not the one that you want. And there you have direct access to the books, or more or less, I mean, depending on the entrepreneur, but no. And this is in a workout cases is resulting in a better, in a quicker reaction, in a better recovery rate. So it's, I mean, we are observing both at entry and in the monitoring, a much better profile.
Yeah, that certainly coincides with what we see. We've supported a lot of non-sponsored lending managers in the market, and it's worked out very well.
We have an annual loss in the portfolio 0.3%.
I'm conscious. I think we've hit our half-an-hour mark. Do we have time for a question, or no? Do we need to move on? Sorry about that. We've done a lot of talking. Hopefully, it was interesting and for everyone. And I'm sure people will be available for questions as we walk out of the room. Thank you very much.